Imagine a world where AFX, trading quietly under the radar at around $0.1173, suddenly steps into the spotlight of one of Asia's greatest financial gateways, Hong Kong. The mere mention of a listing in Hong Kong changes the game. No longer a token talked about in whisper channels, AFX becomes a globally visible asset, exposed to institutional flows, regional investors, and a market accustomed to raising billions in seconds. The idea is simple. A Hong Kong listing isn't just another sticker. It's a megaphone pointing at AFX's ambition and reach. Hong Kong matters for a reason. Its stock exchange, the Hong Kong Stock Exchange, HKEX, links China's capital with a global investor base like few others. Dual listings, secondary listings, and specialist technology frameworks have recently made HKEX one of the most aggressive Asian hubs for companies seeking rapid growth and exposure. According to HKEX documentation, overseas companies may list via a secondary or dual primary route, provided they meet key standards. For AFX, a token born in AI DeFi, but now targeting global visibility, this kind of access is exactly what shifts the narrative from niche to mainstream. Within the AFX ecosystem, the Hong Kong listing could unlock several strategic advantages. First, liquidity, real, deep liquidity from Asia-Pacific investors and global funds. When a token is listed in Hong Kong, it becomes accessible to regional investor networks, trading desks, and high-net-worth individuals who previously waited on the sidelines. That increased participation can reflect instantly on volume, order book depth, and price discovery. Second, credibility. A listing of this nature signals regulatory ambition and market seriousness. For many crypto investors, especially institutional ones, listing in a regulated hub is a debt of trust. Third, utility amplification. When regional access opens, partner pipelines, integrations, and ecosystem usage tend to accelerate. AFX could leverage Hong Kong listing exposure to onboard regional wallets, DeFi participants, and AI-driven services in the APAC corridor. But let's break down what a listing actually does for AFX's tokenomics. Right now, the reward emissions have a known end. The 100-day release schedule finishes, and no new rewards are generated. With supply pressure reducing and demand speculative, a listing provides the trigger event that demand can latch onto. It's the classic supply shock equation. Limited supply meeting increased access and visibility equals potential value surge. The listing scenario turns from maybe someday to opening minutes matter. For someone holding AFX at $0.1173, this shift is what turns latent potential into a visible lever. However, this isn't just positive. Listings come with timing, risk, and expectations. A delayed announcement, a weak debut, or failure to capture regional interest can dampen the optimism. In fact, antiquated or hyped listings have often seen the price move before the listing, meaning any major move could already be priced in. That means AFX needs not just the listing, but execution around it, strong volume, supportive ecosystem announcements, Asia-Pacific wallet growth, and visible on-chain data to prove the listing is more than a press release. At the same time, AFX's existing features become crucial. The AI DeFi platform, the staking protocol that capped rewards, the regional focus, all of it positions the token for this moment. The narrative of the listing won't succeed unless the groundwork is visible. Daily dApp usage, staking migration, wallet growth in Asia, and hints of institutional interest. A listing is a trigger, not a guarantee. If AFX delivers in the background while the spotlight turns to Hong Kong, the listing becomes the launchpad rather than the climax. In terms of scenarios, if AFX were to list with Asian dollar pairing, for instance HKD, and begin active regional trading, the token moves from a solely speculative vehicle to an asset of wider participation. Imagine an influx of new retail wallets from Hong Kong and Southeast Asia, institutional desks gaining access, and regional partnerships being announced. The token could quickly shift from $0.1173 to multiples of that value. The real upside emerges when volume increases, price holds, and the ecosystem usage begins to climb in tandem. For the viewer, this means watching not just the listing date, but the build-up, wallet growth, regional activity spikes, token flow into Asian exchanges, news of integration in RP Asia, regional Pacific Asia markets. These metrics become your checklist when anticipating listing effect. When you track them, you don't just chase listing hype. You interpret signals that the listing is working. Given KEX's evolution, cultural positioning, dual listing flexibility, specialist technology frameworks introduced in recent years under rules like Chapter 18C for tech companies. This regulatory backdrop favors companies and tokens that combine tech ambition with market access. AFX fits that template. AI DeFi meets global finance. Therefore, a Hong Kong listing isn't industrial speculation. It's strategic alignment with both token features and market mechanics. To summarize, AFX's potential listing in Hong Kong could mark a turning point, a shift from rate of expectation to point of execution. From trading quietly at $0.1173 to being watched by regional desks, indexed by APAC traders, and integrated into Asian financial flows. The token's next chapter depends not just on if it lists, but how it lists. Visibility, liquidity, ecosystem integration, and regional adoption all matter. For holders, the opportunity is in monitoring the signals, staying informed, and recognizing that the Hong Kong effect is more than a headline. It's the gateway from niche token to regional asset. There's a growing sentiment in the crypto world that regional adoption, not just global hype, defines the next bull cycle. This is where AFX's Hong Kong ambition fits a larger narrative. The ecosystem is evolving beyond global hype coin status into something deeper, a regional-first, utility-powered, AI-integrated infrastructure. Listing on a globally respected financial hub like Hong Kong allows AFX to embed itself in the kind of real economic gravity that meme coins can't touch. This is where price speculation meets actual strategic positioning. AFX's playbook here is quiet but aggressive. They've already laid the foundation with the AI-defied dApp, the wallet binding mechanism, the 100-day unlock, and community-first governance. But the Hong Kong listing would be the signal flare to the broader market that the vision isn't just technical, it's territorial. While US markets wrestle with SEC friction and Europe inches forward on MiCA, Asia is quietly powering the rails of adoption. And Hong Kong is the epicenter of that quiet storm. If AFX aligns with regulators, exchanges, and liquidity protocols in this region, its tokenomics evolve from finite to focused. Let's consider what happens post-listing. Hypothetically, if AFX begins trading on a major Hong Kong-compatible platform, either directly on HKEX under fintech-friendly frameworks, or on regionally popular CXs that connect to HK wallets, a few things change immediately. First, institutional visibility spikes. Fund managers and crypto desks in Hong Kong, Singapore, and even Taiwan will suddenly see AFX trading pairs appear on their radar. Automated systems and quant firms running Asia-focused DeFi scans will pick up the data. It won't take long for price action to be analyzed against TVL, staking velocity, and reward burn curves. Retail adoption in the Asia corridor is another hidden layer. Hong Kong retail traders are more risk-tolerant than Western counterparts and have easier access to regional DeFi instruments and cross-border payment tools. If AFX wallets become accessible via local DeFi rails, especially if integrated into HK-based launchpads or aggregator apps, then token utility becomes a daily habit rather than a speculative bet. A buyer in Hong Kong, for instance, could stake AFX into AI yield pools, access data services powered by AFX's backend, and see immediate value. This practical feedback loop creates long-term holding patterns rather than short-term volatility. But what about the narrative risk? Listing in Hong Kong doesn't guarantee success. If mishandled, it could create a short-term pump followed by abandonment. This is where community framing matters. If AFX manages its message, positioning the listing not as the climax, but as the next chapter, it retains credibility. They've already proven adept at managing expectations. Remember, when the AI-defied dApp launched, it wasn't just another wallet. It synchronized user data, preserved referral lineage, and routed yield directly. If the Hong Kong listing is framed the same way, a necessary bridge, not an exit plan, the community stays engaged. Let's zoom in on token flow. Pre-listing, AFX is currently trading on select platforms and within the dApp itself. Most volume is internal. But once the listing goes live, if liquidity migrates into Hong Kong exchanges, we'll see a bifurcation of token markets. One internal, dApp-driven and incentive-backed. The other external, driven by exchange demand, speculative cycles, and arbitrage. This opens up several high-potential movements. Traders moving tokens between ecosystems, regional whales entering the books, and increased staking due to visibility spikes. From a macro view, consider the supply squeeze. With the staking protocol now capped, no new rewards after the final 30 million AFX have been distributed, and no new emissions. The only way for new users to enter is through purchase or transfer. That means every new participant post-listing adds pressure on existing holders to either part with their tokens or stake deeper. Scarcity intensifies as demand meets capped supply. This is the classic crypto scarcity model, but paired with real regional volume, not just hype. The result? Price discovery based on utility, not fantasy. Let's not forget the symbolic value. In 2025, being visible in Hong Kong is as much about reputation as it is about regulation. For a project like AFX, rooted in AI, DeFi, and scalable user architecture, that kind of positioning opens doors to partnerships beyond tokenomics. Regional AI firms, DeFi dashboards, payment gateways, and metaverse-linked platforms are all headquartered in or around Hong Kong. With the listing, AFX could position itself as a protocol partner, not just a traded token. These integrations don't happen overnight, but visibility is the first step. The psychology of holders will also shift. At $0.1173, current holders view AFX as early stage, cheap, high upside, low volume. But post-listing, the same price is interpreted through a new lens, undervalued compared to potential, or overvalued if regional metrics fail. This reframing affects holding behavior. A successful Hong Kong debut creates long-term confidence. People hold through dips because of future integrations and Asian roadmap visibility. A weak debut triggers the opposite, exits before regional adoption has time to grow. This is why narrative control and roadmap transparency post-listing are so important. In truth, this is what separates AFX from others in its class. The team behind it isn't chasing listing hype. They're building parallel infrastructure to support it. Every update, from staking emissions to dApp sync to reward redirection, has been a clue. The listing isn't standalone. It's a culmination of months of ecosystem re-architecture, designed to position AFX not just as another altcoin, but as a full-stack digital asset. Usable, viewable, tradable, and stakeable across both Web 2 and Web 3 layers. And now we begin to see how all of this connects. Hong Kong isn't just a market, it's a multiplier. It amplifies what's already been built. It tests what's been promised. It rewards what's been delivered. If AFX steps into that arena with clarity, compliance, and conviction, the market will notice. At $0.1173, it may be undervalued. But after a Hong Kong debut, if volume rises, integration is visible, and supply remains constrained, we may never see that price again. The next chapter, as they say, writes itself. There's a reason why the crypto community is watching the Hong Kong narrative closely, not just for AFX, but for the broader implications of how capital, compliance, and crypto collide. Hong Kong's regulatory landscape has evolved from a cautious observer to a calculated innovator. The SFC's gradual opening of licensed crypto exchanges and token listing frameworks means that listings now carry legitimacy, not just hype. If AFX secures a spot in this new regulatory climate, it's not just getting a price boost, it's entering a zone of long-term survivability, even amid bear cycles. This environment also redefines what adoption looks like. In Western markets, adoption is often app-based. Download this, connect wallet, tap to swap. But in Asia, and especially Hong Kong, adoption is deeply tied to finance infrastructure. People don't just use apps, they invest through them. If AFX positions itself as a bridge between traditional fintech and emerging DeFi, Hong Kong becomes the epicenter of a new hybrid model. That's the frontier, not just dApps, but dApps with KYC integration, fiat ramp compatibility, and AI-powered insights for everyday users. It's not a coincidence that AFX emphasized community autonomy in their last announcements. By canceling all referral networks and VIP reward tiers, they cleared out the centralized incentive structures that might appear problematic to regulators or misaligned with DeFi values. This pre-listing cleanup is tactical. It makes the ecosystem more neutral, more balanced, and, crucially, more transparent. When Hong Kong regulators examine the protocol, what they'll find isn't a hype machine or a Ponzi shell. They'll find a clean DeFi protocol with visible yield logic, wallet binding, and no hidden uplines. Now let's turn to the user base. Post-Hong Kong listing, one of the biggest changes isn't just volume or visibility, it's cultural alignment. Asian crypto communities value structure, consistency, and progress. They don't chase chaos, they reward discipline. If AFX delivers consistent UI updates, roadmap transparency, and staking reliability, this user base sticks longer, trades deeper, and builds community-level infrastructure, from unofficial Telegram groups to regional dashboards. That's how tokens go viral in Hong Kong, not through ads, but through collective visibility and trust. The ripple effects can't be overstated. Listing in Hong Kong triggers media coverage, not just on Cointelegraph or CoinDesk, but on local outlets, influencer circles, and Chinese-language YouTube shows. AFX, a token quietly climbing to $0.1173 on decentralized merit, will suddenly be shown side by side with regional giants. And the psychology of relative value takes hold. If competing tokens with weaker architecture are trading at 40 cents, 80 cents, or even $2, investors will begin asking, why not AFX? This speculative psychology drives short-term spikes, but it's the infrastructure that sustains them. And that's what makes the timing critical. The 100-day release window means thousands of wallets are receiving daily unlocked AFX. But once those wallets receive their final allocations and staking is shut off, the only way to acquire AFX is through external exchange buying. If Hong Kong listing happens as this transition completes, then the demand curve surges just as supply growth ends. This is what tokenomics designers call the scarcity convergence point, and few tokens ever reach it cleanly. Let's run the numbers. Suppose there are 10,000 active wallets currently receiving daily 1/100 unlocks. By the end of the cycle, they'll have 100% of their AFX, and the ecosystem will stop issuing rewards. Simultaneously, the staking mechanism is deactivated. The faucet turns off. Now, enter a Hong Kong exchange listing. That exchange might see a sudden surge of 20,000 new traders, each seeking a position. But where do they get AFX? The dApp no longer mints. The only sellers are former holders, or those converting unlocked rewards. The result is scarcity-induced price momentum. But this price movement isn't purely mechanical. It's psychological. As volume grows and price climbs, say, from $0.1173 to 20 cents, 30 cents, and beyond, it attracts algorithmic traders, market bots, and arbitrage desks. These actors push the volatility upward, which in turn draws influencer attention, and the cycle feeds itself. What begins as a low-volume listing on a regional platform becomes a regional price spike, and if it sustains, a global attention magnet. That's the snowball effect Hong Kong unlocks. There's also a narrative opportunity here. AFX isn't just another token listing in Hong Kong. It's doing so after months of ecosystem restructuring, AI-integrated DApp rollout, and complete DeFi compliance. If the team communicates this clearly, with an updated roadmap, visible audit results, and Hong Kong-aligned UX features, they position AFX not just as another tradable asset, but as the leading AI x DeFi coin optimized for the Asian market. This positioning is powerful. In a cycle where users are overwhelmed with L1 clones and meme coins, clarity becomes alpha. And then there's the broader macro layer. As tensions between Western regulators and crypto projects continue to simmer, Asia has emerged as a regulatory safe haven. Hong Kong, Singapore, and Seoul are forming a kind of DeFi triangle, offering credible legal paths for projects with structure. AFX entering this zone is strategic. It opens doors to institutional partnerships, accelerator programs, and even cross-chain integrations with Asian L2S. Once visibility is established, the next steps write themselves. Mobile integrations, API partnerships, fiat ramps, and perhaps even localized NFT projects. All of this adds up to something bigger than a listing. It's an identity shift. Before, AFX was a project with a loyal base, smart tokenomics, and ambitious tech. After Hong Kong, it becomes a regional player with global scalability. Its floor price rises. Its holder count deepens. Its community evolves from speculative to strategic. And if this transformation is successful, AFX could go from being a DeFi token with potential to a financial instrument with presence. That's not just evolution, that's ascension. What happens next depends on timing. Not just market timing, but message timing. Because the AFX story isn't just about charts and prices. It's about precision. When the team chooses to launch in Hong Kong, the news cannot land quietly. It has to hit the market like a signal. The messaging must echo with confidence and clarity. AFX is ready for global scale, and this listing proves it. This single phrase, if delivered correctly, sets off an entire chain reaction of investor interpretation, influencer coverage, and algorithmic alerts. Timing matters even more because we are entering a speculative season. As Bitcoin steadies and altcoin narratives shift from infrastructure to impact, the market begins searching for the next story. AFX, with its AI DeFi fusion and scarcity-backed tokenomics, is already positioned as a next-gen asset. But listings, real listings, on exchanges like those in Hong Kong, are what crystallize narratives. If that launch is coordinated with influencer campaigns, staking dashboards, and DApp improvements, it doesn't just announce readiness. It declares momentum. That momentum, once visible, forces the hand of larger traders. Whales, who were previously cautious, start exploring on-chain wallet flows. Analysts on Twitter begin comparing AFX's supply model to those of previously mooning tokens. YouTube explainer videos pop up. Suddenly, the conversation shifts from what is AFX to how far can AFX run. And it's here that the 100-day cycle comes back into view, because unlike typical altcoin cycles driven by emotional exit pumps, AFX's model is engineered for a long fuse. By the time all staking ends and rewards are fully distributed, the ecosystem becomes a closed loop. No more dilution. No new inflows. Every coin on the market is already in someone's hands, meaning every buy has a greater impact. If the Hong Kong listing lands around this time, the token enters a new state, price-sensitive scarcity. Each price move, up or down, becomes sharper, faster, more dramatic. Traders recognize this. They start entering with tight risk-reward ratios, and liquidity begins deepening. The psychological effects deepen too. As price approaches its previous high, say 15 cents or 20 cents, holders begin sharing screenshots. Telegram groups erupt. X/Twitter threads emerge with speculative math. What if AFX hits $1? What if the circulating supply stabilizes under 200 million? The ecosystem becomes reflexive. Excitement drives demand. Demand lifts price. Price attracts influencers. Influencers attract volume. And through it all, the protocol remains untouched, silent, reliable, and mathematically limited. This is how legacy begins. Not in hype alone, but in consistent, composable visibility. And if the team is bold, they can extend this visibility with partnerships. Regional dApps, NFT vault integrations, AI plugins for yield simulation. Every small addition expands the utility horizon, and in a DeFi winter, utility is king. It's what separates tokens that flash and fade from those that become infrastructure. AFX, now listed, now circulating, now adopted, becomes something new, dependable. We also can't ignore the psychological parallel between Hong Kong listing and legitimacy. Users subconsciously trust tokens that go through regional compliance. They associate it with accountability, with audits, with international reach. This trust translates into transaction volume, but also into wallet commitment. Users move from speculative short-term trades to long-term holding. They start building portfolios with AFX as the base layer, a bet not just on price, but on presence. As presence expands, so does market pressure. Larger exchanges, Binance, Gate.io, Bybit, begin monitoring liquidity flows. If AFX outperforms peers in retention, DApp engagement, and wallet transactions, it becomes a listing candidate for global venues. These secondary listings carry compound impact. Each one raises the ceiling. Each one adds market pairs. Each one exposes AFX to new communities: Filipino, Korean, Turkish, all of whom look for undervalued, narrative-rich assets with low float and deep potential. The irony is that all of this begins with restraint. The team didn't chase hype. They didn't rush listings. They waited, restructured, simplified, and aligned their narrative to where the market was going, not where it had been. That's the mark of maturity. And in a market where users are hungry for reliability after cycles of collapse, maturity is magnetic. It attracts not only capital, but conviction. In time, we may look back at the Hong Kong listing not just as a price event, but as a pivotal moment, the inflection point where AFX transitioned from ecosystem staking into open market valuation, from private ecosystem to public trust, from niche project to DeFi legacy. And for those who held through the silent phase, through the unlocks, the restructuring, the protocol shifts, this phase is more than a reward. It's a vindication. And now, as the ticker refreshes and the price reads $0.1173, it no longer looks like a random number. It looks like a spring, a compressed coil, a countdown waiting to ignite. The question is no longer, will AFX survive the market? The question is the market ready for what AFX is about to become?